How is the labor market in your view?
Yeah, I mean, those data and anecdotes certainly match with the WARN data. So companies, before they engage in large-scale layoffs, they have to issue these WARN notices to the state. And we did notice October is a very high month. However, what we also noticed is that roughly 15% of those WARN notices might be related to temporary furlough and temporary job cuts. So I think from a conceptual perspective, given that we just had the longest shutdown, and at least in the Washington, D.C. area where I am, without the government workers working, the people working in the restaurants around here, which are oftentimes paid on a weekly or biweekly basis, they will not be showing up in any of these private payrolls. ADP is focused on private payrolls. So I think naturally what should happen is upon this reopening of the government, we should see a bounce back in consumption, and we should see a bounce back in some of the payrolls that were lost in October.
You know, I got to say, Anna, it's kind of wild to finally go to EcoGo on the Bloomberg terminal and actually see some data points filled in, because it's been so empty, certainly, because of the lack of government data. Yeah, it's kind of interesting, this environment we're in. Will the Fed have a fuller picture of kind of what's been going on by the time they meet for that December meeting? I guess I would say yes, but what's your take?
Yeah, I think the difference between the data that the Fed has versus what the private sector has is their conversations with CEOs and regional business contacts. So we know the Beige Book is coming up next week, and we have already seen in various FOMC official speeches they're referencing the Beige Book. And so I think I would put a lot of weight on how the Beige Book next week characterize national employment, whether it's mostly flat and whether it's declining in most districts. That sort of comment would, I think, would get a lot of weight in the FOMC consideration for December.
So what's the right outlook for the December 10th meeting?
I think that once the data on November start trickling in, which is basically the data that the Fed will have upon their December meeting, it will not point to significant improvement. I mean, at least the data won't show that. So my sense is, so first, there's the first wave of shutdown data, which is from September. The September data, which predates the shutdown, would be pretty strong. I think would be pretty decent. Would not move the dial on a cut in December. But the next wave that comes in late November and early December would add to the chance of a rate cut in December, because those would be the weaker data.
I mean, is the U.S. economy at risk of more? I guess what I should say, if you look at the balance, more risks or more possibility of outperformance? And I think about a lot of our guests come on, Anna, and they talk about the president's, recent big legislation that just passed, tax breaks and so on and so forth, that will kind of give some more juice into the economy. So I'm just curious, as you look at all the metrics that are coming at us, how do you see it?
I think both could be true at once, Carol. I think this K-shaped economy narrative will persist through 2026. So our view for 2026 on the whole economy performance is fundamentally bullish, because we are seeing multiple headwinds from this year turning into tailwinds next year. So, for example, the fiscal impulse from One Big Beautiful Bill, we're already seeing in the earning calls in the third quarter so far. One reason why the tariff hit on earnings is not as large as thought is that, in fact, some of these tax credit is already working through the system. Mm-hmm. And also trade policy uncertainty has been coming down, and that drag from tariff should be easing next year. Also, of course, there's whether the Fed will be cutting rates. We do think the Fed will continue with its rate cut cycle, and as rates come down, that should also spur some of these more cyclical sectors like housing housing and production to come back, reverse at least in the second half of 2026. We think by then the economy will be doing well. That said, the labor market might lag, might continue. The unemployment rate would be rising in the first or second quarter and would lag the whole economy in terms of improvement.
Why? Wait, why? Because of AI?
I think dual forces. Number one, the labor market is actually slower than the rest of the economy in reacting. The fastest sector in responding to Fed cuts is the financial market and the housing market. And generally, the labor market lags Fed moves by about 18 to 24 months. So I think that it's highly possible that the unemployment rate could still be rising, partly because of that cyclical pressure. And on top, the AI definitely, in my view, is playing a role in driving unemployment rate higher as well.
We're going to be speaking about AI in just a few minutes with Mandeep Singh of Bloomberg Intelligence and Ian King of Bloomberg News. And a big part of the conversation is going to focus on the questions around the bull case for artificial intelligence, because one analyst downgraded Amazon and Microsoft, noting that the trade should be approached with caution. I'm not going to ask you about the bull case for these companies. What I'm going to ask you about is the economic effects if this technology succeeds on the labor market. How does that fit into your calculations, not just for next year, but for beyond?
Economists love to see productivity boom, but productivity boom is also a unicorn in the world of economics. It comes maybe once every 2 decades, and you love to see it. But even if that unicorn is there, there's also the question of, do you see that it's actually a unicorn, or is it like concealed in some other costumes? And I think, in 1995, when Alan Greenspan recognized that the economy is going through a productivity boom, none of the data was showing it. In fact, half of the FOMC committee that argue against the rate cuts because they didn't see it. So if we were to wait until the productivity show up in aggregate data, it would be basically too late for the Fed. They would be basically choking a productivity boom for a couple of years. However, I think right now, I'm seeing is some micro evidence that AI is boosting productivity at specific sector level and very concentrated right now. However, I think in a year or two, certainly by 2028, the evidence of the productivity impact would be much more obvious than today.